We're delighted to welcome you here today. I think we're going to have a very interesting set of discussions. Japan clearly is not the major focus of this conference, but in the second panel, we do have some discussion, in part because Bruce described Japan as a countervailing case. It certainly was. Japanese financial institutions were directly hit much less hard by the financial crisis than American institutions or European. As you all know, the crisis was caused by many mistakes in errors of judgment and was abetted, as I guess is always the case, by a certain amount of lapses in ethical behavior. I guess it's called fraud or things of that sort. As I was thinking about it, it seemed to me that by and large, Japanese and Americans, individuals and institutions, share pretty much the same set of values or ethics in terms of business behavior. But there are indeed some subtle differences. And since this is my moment to say something about Japan that is really not directly relevant for the conference, I'll point out that, for example, you know, America has a highly individualistic society, and so we're really focused on equality of opportunity. In Japan's more group-oriented society, they're much more, the norm of equality of outcome is more important. And that shows up in differences in the way companies or financial institutions organize themselves, promote and reward their staffs. Americans think Japanese don't reward merit and performance quickly enough and are very slow to promote, and that's inefficient. Japanese think that the American system, in which there's differences in salaries between their senior executives and American senior executives, is immense. And so I think many Japanese say, well, this system of incredibly large bonuses is, they don't say inefficient. What they say is it's outrageous, exorbitant, and maybe even immoral. So we have differences in values on specific things. Another difference, for instance, is Japanese management give priority to their regular employees, both blue collar and white collar, at the expense of shareholders. And that is something that many Americans think is inefficient and not fair. In a sense, floating in all of this is the idea of how to allocate resources efficiently, which I think we take that as a value. We take it for granted that usually that's what we're concerned about. But systems that misallocate capital or other resources, we certainly label as inefficient, but it's more than that, because it involves the values of what do you do about who gets the benefits of a misallocation of capital or other resources. And that leads into what is the fundamental issue, ethical issue, I suppose you would say, for every society, which is what is the fair distribution of income. But basically, that's a topic that's really far beyond what we're trying to do today. And my job is simply to welcome you, ask you to listen carefully, ask you to ask good questions, and then for me to turn it over to the real leader of this conference, Bruce Kogut. Bruce?
Thanks, Hugh, for that introduction. I would like to start these comments to the conference and to Donald MacKenzie, who we're so delighted to have here today, by exercising an option to begin with a dynamic program. So I'm going to start from the back and move forward on this. I'd actually like to thank the people who helped us create this conference, particularly the Center for Japanese Economics and Business. I'd like to thank Amiko Mizumura, Ginny Woods, Kahari Takashi, and of course my colleague Hugh Patrick. For those who know Hugh, he was kind of the exemplar of a scholar and a gentleman, and his enthusiasm support for this conference attracted many of the really wonderful speakers we have, and also many of the people who are here. I should also say special thanks that he brought to us Takahiro Ito from Tokyo to join us as well. From the Sanford C. Bernstein and Company Center, I'm always amazed by their sang-froid, by their ability to pull these things together so gracefully, particularly Anna Berger and Carolyn Tharp. I always am very lucky to have, as a co-director, Sandra Navalli, who just does these things so easily, but also is a great intellectual colleague on these issues. And finally, I want to thank the people who will be on the panels and who will speak to us. They're such busy people, and it's so nice for them to come here for what we call a research conference. Research conference means that we actually, do talk about the research that we know. In finance, research is done, I don't know if it's equally, but it's done, and I'm not sure which way the balance goes, but considerably on both sides of academics and practice, which makes it so interesting to have people here from industry as well as from Columbia and elsewhere. I'd like to thank the panelists who are chairman, Ron Gilson, who will keep us legally in line. And I asked him to talk about some of the legal implications, including liability law, which is interesting for financial innovations. But particularly Paul Glasserman, because Paul has been such a great colleague to us, to me, over the years, and particularly this conference. Wasn't obvious that someone, Paul, would take so quickly to sociology of science, but I misjudged Paul. He's a broad man, and he was enthusiastic, I would say, absolutely persuasive to have this discussion go forward. And I think what made it so much easier is that he, as so many of us have recognized, that Donald really speaks as an expert in this area with a really great understanding of the topic. And I want to thank the sponsors as always, and of course the Dean's Office for their support, and give you Chris Mayer's regret that he cannot be here. Now, we have a lot of people in the audience. It's a wide diversity. We have people from the law school, from the business school, from economics, from financial engineering. We have 2 chairs of the departments here at least, maybe more. And we have a lot of people from industry here as well. So one of the things which I asked myself was, why do we attract such diversity on this topic? I think there are 2 reasons why. One is that many of us actually already know the work of Donald MacKenzie, which I'll say more about in a second, but I'll just state what I think is a primary contribution, and that he really has explained and explored very richly the thesis that financial innovation arises out of this interplay of science and technology, and carries with it all the human and moral complexities found in the sister empirical domains, whether it be information technology or nuclear physics or medicine, engineering. And I think this is a fascinating exercise to look at what we do in terms of science and technology and have that chance to discuss it. But of course, the second reason is the financial crisis itself, and the role of quantitative finance in it. Now, it might be easy to think that the subtext of today is that financial innovation created the crisis, and hence innovation is bad. But I think that such a deduction is too quick and is largely suspect. But what we don't have is major debates like what we have on Intel's latest chip, which might reduce the demand for labor, whether it's responsible for unemployment or whether such innovations are systemic. In fact, they are systemic from other industries as well. So why are there such debates currently about financial innovation when we in fact see such things elsewhere? I mean, it drives economic growth, we could argue, so why all the fuss? So I think there are a few reasons why, and why has brought so many of us here today. And one of them is this disparity between the social and private value. I think finance has not demonstrated persuasively to everyone that the social value it adds is commensurate with the private value it adds to relatively few privileged people. So indeed, Hugh, I think that this is something we can avoid in this kind of discussion. The financial industry has grown to about 8% of the GDP. I'm told a third of corporate profits in certain years. These profits are net of wages, which are highly skewed towards rewarding a small percentage of the population. Now, these are important societal issues and also in terms of the power which it brings with it. But it also, poses whether or not, whether we understand why there's such profits in this industry. And I will confess, I've yet to hear a persuasive explanation why there is such profits. And it puzzles me why we have not addressed this, given that other industries which have great profits, like computer chips or computer software, have been forced to explain why they have been so well benefited. The second reason is that the financial innovation seems to lead to a proliferation of systemic risk. Now, there's a great frustration, I think, about finance, that it's very proud of its scientific foundations, but really does not have an open debate about whether or not it's responsible for consequences in society at large. I think maybe this is unfair, but this is basically what we're talking about today. If financial transactions was simply a poker game among people at a table, and this is the background to that book, Liar's Poker, which is a great book, I don't think we'd care that much. But the truth is that their externalities are real, and we really have not had a great discussion about these externalities and the risk which they pose to many people who are really innocent bystanders to the industry. And finally, I think the reason is that financial innovations move at great speed. Donald MacKenzie wrote at one time about the diffusion of nuclear bomb technology, had an interesting discussion of whether it will go quickly, how quickly it can go to countries like Iraq and elsewhere. It's about almost 20 years ago, which seems to be a timely discussion. The financial innovations diffuse, very, very quickly. They move rapidly from being created one day to being used around the world, which is why the international comparisons are so interesting. Richard Bookstapper, who couldn't come today, unfortunately, noted in his book that when he was selling some of the derivative products to Japan, that very quickly he realized that the Japanese were buying the minimal amount of the product. They didn't want to pay anything more than they had to, in order to backward engineer the technology behind these products. And this is the first time I heard Japanese backward engineering apply to something in finance, when we had such great discussions about it in automobiles and microchips and other industries itself. So it diffuses very rapidly, and it diffuses quickly to places of the world which maybe not even wish to have it or understand they actually are engaged in the systemic risk which is now spread so widely. So I think it's critical that we think about these comparative lessons, particularly because these things do spread so quickly. We can only test them in real time, so we should turn quickly to actually making this analysis. Now, Donald MacKenzie is the right person, I think, to start this discussion for us. He has a chair, I think it's a personal chair. I'm not sure what a personal chair is, but it sounds like a great thing to have. You don't have to say thank you to anyone. It's just, it's just a chair which you have. He has a lot of awards. I won't tell you the list of awards, but you go to his website or elsewhere, he's tremendously well recognized. Trained in mathematics in his first degree, his PhD in sociology, really the sociology of science. And he's been working on many things. He did his thesis on the sociology of statistics, wrote the debate. One of my colleagues in sociology reminded me about why Pearson's R, I think, is dominated over the Yule statistic. And since many in the room like Yule distributions, it's a noteworthy discussion to have had. I told you about the nuclear bomb work which he's done. And he's also been the leader on finance and as a technology. His work, his article published in 2003 with his colleague Yulof Milo, looking at black shoals, I think was one of the classics written on this topic in general in the study of technology, because it was so true to what the technology was, great understanding, and he pointed out so well issues of what it means to have a performative technology and a counter-performative technology itself. But I won't say much more because I know Donald is going to tell us this thing. I just want to conclude on one last thing, and then I'll turn it over. We are a center on ethics, so why do we actually worry about this? And I think you already have some intonations why that's the case. So when people always think about technologies, they always think about Frankenstein, and people who study science technology always laugh about that because it's kind of an old story. But it's not actually too far away from the monsters turning back on their masters in this particular crisis. But I like science fiction. I suspect many of you in this room like science fiction. So I always think of Asimov and his three principles of robotics. The first one is that the robot should not harm human life. And I think on that score alone, one might say whether or not that's been violated in terms of some of these financial innovations. But who's to blame? Who's to blame on this? Which I think is an interesting question for us. Clearly, it's not the software. A robot, after all, is just software. And a financial innovation is just software. So is it the people who consume the software? Is it the people who create the software responsible? If they can't be made responsible for it, should we have governments regulate it? Should we have self-regulatory institutions be involved for it? Should we have lesson discusses for code, things about how the code should be written itself? So I think these are some of the topics which we have to discuss today. Ultimately, is about who's responsible for these things. And I'll let Donald start it off in this conversation, and then maybe we can turn to this a bit later. Thank you so much, Donald, for coming.
Well, thank you, Bruce, for that extremely gracious introduction. I kind of feel the best thing I could do now is kind of sit down, because the talk is bound to be an anticlimax after such nice remarks. But seriously, thank you very much for the invitation, and I'm very much looking forward to our day today. I'm going to talk in 3 parts. I'm very quickly going to introduce the terminology of performativity. Then I'm going to take as my main example Black-Scholes-Merton option pricing theory. And I'm going to ask Bruce to show me when I've spoken for 20 minutes, because I want to leave just the last sort of 15 minutes of the talk to throw out some ideas to get us started in terms of the discussion of the role of models in the financial crisis. So, performativity. Supposing I was late to come give this talk, and I came in and I said, I apologize. That utterance is what the philosopher J.L. Austin called a performative utterance. It doesn't describe some external state of affairs, but it brings that state of affairs into being. Now, the postulates of economics aren't simple performative utterances in most cases in that sort of sense. So what I would propose is this way of thinking about the issue of the performativity of economics. And this slide is on the handouts lying around the table if you want to refer back to it later. So the way to think about it is as a sort of subset diagram. So the outermost set is what I would call generic performativity. That's where a piece of economics isn't any longer simply in the textbooks or the textbooks or the lecture theatres, but starts to be used in economic practice. Next in is what I call effective performativity, and that's where the use of a piece of economics starts to have effects on patterns of prices, starts shaping economic processes in some way or another. Then the 2 innermost subsets are the ones that really interest me. First here, what I call Barnesian performativity, which is a reference to the sociologist of science and social theorist Barry Barnes. That's where the use of an aspect of economics actually starts to make economic processes more like the postulates of the aspect of economics in question. But once you formulate things like that, you can see that there's an obverse case that I call counter-performativity. So counter-performativity is where an aspect of economics is being used in practice, where its use is having effects, but the nature of those effects is to move economic processes away from the postulates of the aspect of economics in question. So that's my terminology. So I'm now going to apply it to what is, I suppose, the most influential financial model of all, the Black-Scholes option pricing model. Now, I assume just about everybody here knows what an option is, and because I'm trying to get through a lot of stuff fast, I'm not going to run through the definition of an option, but here, in case you need a reminder, is what an option is. What option pricing theory does is to give an account of how economic processes determine the price of options. There's a long and an interesting theory, and there's a long and an interesting history of option pricing theory, but I'm going to leave that entirely aside and go straight to the canonical Nobel Prize winning solution by Fisher Black, Myron Shoals, and Robert C. Merton. And what they did was to show that given certain assumptions, it's possible to replicate an option completely, to construct a continuously adjusted portfolio of the underlying asset and holdings of cash, a replicating portfolio that mirrors the option, has the same payoff as the option in all states of the world. So if you then think about the portfolio that consists of the option plus this replicating portfolio, it's riskless, so it can earn only the riskless rate of interest, because otherwise there's an opportunity for arbitrage. And that argument suffices to derive the famous Black-Scholes option pricing equation. I assume most people here have seen it. If you haven't, perhaps you should have, because as the option theorist Mark Rubinstein points out, this is in all likelihood the most used equation of anything like equivalent complexity in human history. The total notional amounts of derivatives outstanding at the end of June was $668 trillion. If you're a mere sociologist like me, that's the sort of figure that makes your head hurt. So I translate it into more human terms by thinking, well, there's 6.7 billion people on the planet, so that's roughly $100,000 per person. A big market. This equation and its analogues at the heart of it. So literally solved more often, I would suspect, than any of the equivalent equations of science and engineering. And that's its canonical solution, the solution for a call option. So that's by way of theory. Where did this meet economic practice? Well, above all, in the options trading pits of Chicago, particularly the Chicago Board Options Exchange, founded in 1973 at roughly the point at which the equation was first published. Now, one of the great joys of this piece of research was I was able to see Chicago's option pits, its open outcry trading pits, while they were still going strong. This room would be just about as big as the biggest trading pit in Chicago. Imagine it stepped around the sides with perhaps 400 or 500 traders packed into it. The kind of tales that open outcry pit traders tell you are quintessentially tales of the body, because of course that's somewhere where deals are entered into by voice, or if it gets too noisy, which it often does, by hand signals, palm away from the body, indicating an offer to sell, palm towards the body, indicating an offer to buy, the fingers indicating how much you're offering to sell or to buy. So the stories traders tell you are stories about bodies. Of the voice coach who taught them to shout all day without becoming hoarse. Of being covered in spit by the effects of the person behind them shouting. Of the smell, because those jackets are polyester, and you imagine sort of human bodies, hot human bodies in polyester jackets. Of their knees giving way in middle age from the effect of standing all the time. Of it mattering where you stand. The desirable place to stand is the top rung of a pit, partly because the lines of sight are better, partly because that's where the big brokers who bring the big customer orders stand. And if you know a broker well and you say to him, "What are you doing at the close?" he might do a little hand signal, invisible to the video cameras, that's still economically important information. So because it matters where you stand, people compete to stand in the desirable places. So there's a lot of jostling. There's even fist fights that break out. And above all, people are monitoring each other's bodies. They're looking for those little sort of uneasy movements or just eyes flicking around that indicate fear, that indicate a trader who has to buy or has to sell. So how do you do that in that environment? Back in 1973, when computers were big, bulky things. Using paper sheets of theoretical option prices. A service sold by, amongst others, Fisher Black. I don't know if you can see this, probably not, but at the bottom there it says, if you have any questions, call Fisher Black, and then the Cambridge Mass telephone number. And what traders used to do was to carry bundles of Black's sheets, wrap them up tightly in a wad like this, so that just the immediately relevant row was showing, so you could just quickly glance down and see a theoretical option price as you were trading. It wasn't always well regarded by pit traders in Chicago. One of the best known of them, Blair Hull, told me that other traders would even question his masculinity for using theoretical value sheets. They would come up to him and say, "Trade like a man. You're not a man if you're trading with those theoretical value sheets." They would even grab his sheets, throw them to the ground, and say to him, "Now trade. See if you can trade now." But the wimps, with their sheets, did actually win out over the real men. Why is an interesting question. I suspect it wasn't the authority of financial economics, wasn't a huge part of it. More important, I suspect, was the fact that the Black-Scholes model, because it had been published in the Journal of Political Economy, was publicly available, whereas the other competing models were often proprietary models that people kept to themselves or would make available only at very large prices. So it's a little like the story of the PC and the Apple. The architecture of the Apple, to my mind, is superior to that of the PC, but of course Apple kept it proprietary, and so the PC won out. Black-Scholes also has the advantage of being cognitively quite a simple model. There's only one free parameter, volatility, and that's quite an important cognitive feature of the model. People used it in a variety of ways, of which the most interesting in terms of my talk is the fourth here, the strategy called spreading, where you simultaneously bought an underpriced option and sold an overpriced option on the same stock. From 1973 onwards, option prices fell in relative terms compared to all previous option markets that have been studied. There's a couple of very nice papers recently in the Journal of Finance and the Journal of Financial Economics that delve into this in detail. It would be a mistake, I think, to think that this was a simple performative effect of the model. The fact that options started to be traded in a competitive open outcry Chicago pit was probably more important to this fall in relative prices than the model per se. But option theory actually helped that competitive market get going because it provided legitimacy. Options had always been just a little bit dangerously close to bets, both in the public eye, but also sometimes in the view of lawyers. Burton Risman, who was the counsel for the Chicago Board Options Exchange, told me that he thought that Black-Scholes was crucial to the success of that exchange, but not in a technical sort of way, in his opinion, but in providing legitimacy, in separating out options and bets. Black-Scholes also made it easier to talk about options because they're kind of complicated sort of things. You've got puts, you've got calls, you've got different strike prices, you've got different expirations and the like. What people did was to take Black-Scholes, solve it backwards to work out the level of volatility consistent with the price of options, and that became a way of talking about options, indeed sometimes a way of quoting option prices. So options would be quoted not in dollar amounts, but in amounts of implied volatility. Widely used now, for example, as a way of thinking about the condition of markets. The Chicago Board Options Exchange VIX, sometimes regarded as a fear gauge, is very important in that respect. What about the question of Barnesian performativity? Did the use of the model make the model more true? Well, that's a tricky sort of question. To the extent I think it's possible to answer it, the most direct way is using the work of Mark Rubinstein, one of the premier empirical testers of the Black-Scholes model. And what Rubinstein essentially does is to look at the relationship between the exercise price of options and the implied volatility. So these are all options on the same stock. On the Black-Scholes model, the volatility is simply a feature of the stock. It shouldn't be influenced by the exercise price. So if the model is correct, that graph should be a flat line. And Rubinstein found, studying prices from the Chicago Board Options Exchange, that it was a pretty flat line. But then think what a spreader is doing. As I said, what a spreader does is look for underpriced options to buy, and implied volatility, the higher the implied volatility, the higher the price. So this is a relatively underpriced option, and overpriced options to sell, like option there. And the effect of spreaders doing this was actually to shift prices towards the flat line. If you subscribed to Fisher-Black's service, amongst the introductory notes that you got was simple instructions as to how to perform spreading. So the practical use of the model helped shift patterns of option prices towards the postulates of the model, which is what I mean by Barnesian performativity. And the fit got even better when index options were introduced. Rubinstein found typical residual differences of the order of 1%, this is social science after all, and that's pretty good fit by social science standards. So financial economist Steve Ross, writing in 1987, said, when judged by its ability to explain the empirical data, option pricing theory is the most successful theory, not only in finance, but in all of economics. So a nice smooth tale of performativity. Well, actually not quite, because the date of that quote, 1987, is quite important here. The second most important practical place where theory and practice in terms of option pricing got together was portfolio insurance, which is the use of Black-Scholes option pricing theory to synthesize a put. In other words, you create the replicating portfolio that's part of the derivation of the model. You create that in reality to give yourself a floor below which the value of your portfolio should not fall. The key point, though, is that the synthesis of a put, as I said when briefly introducing the model, the replicating portfolio is not a static thing, it's continuously adjusted, and the adjustment when you're replicating a put demands that you sell when prices are falling. That is almost certainly a significant contribution to the 1987 crash, and to the extent that it is, it's a counter-performative effect. The size of the crash, for example, is a grotesquely unlikely event on the log normal model underpinning Black-Scholes. There's even possibly a bodily element to the crash. I interviewed Nassim Taleb for this study long before he published The Black Swan and became famous. He'd been an options trader in the Chicago Mercantile Exchange, and he told me this about the pattern of bodily interaction in the floor of the Chicago Mercantile Exchange, which is where index futures, which was mainly what the portfolio insurers were selling, was traded. The crowd detected a pattern of a guy who had to sell as the market went lower. In other words, a broker, particularly the broker for Leland O'Brien Rubinstein, the main portfolio insurers. And they noticed the fear. So the empirical history of option pricing divides into three phases. When the model is first introduced, the fit to reality, there's reasonable fit, but it's only an approximate fit. The second phase, the fit gets a lot better, but my argument is that it gets better because reality adjusted to fit the model. And that phase lasts from the middle of the 1970s through to the summer of 1987, and that's the phase of what I'd call the Barnesian performativity of option pricing theory. And then a third phase from then until the present, where once again there is a systematic deviation between the model and reality in the form of the volatility skew. Now I've actually had an Apple Mac PC issue in these slides, and what they've done is actually censored the slide that shows the skew. The top slide is a pattern of prices. This is again taken from Mark Rubinstein's work from before the crisis, and you can see that's not an exact flat line, but a pretty good flat line. And then what the second slide at the bottom should show, but doesn't, it's a slide from after the time of the crisis is the line goes down like that. That's the volatility skew, and it's very, very far from a flat line. So to end, and I'm going to do this briefly, and just tell me when my time's up, Bruce. Just to end, how might one apply this kind of way of thinking to the credit crisis? Well, this is very much work in progress, and I essentially just throw out some of these ideas to get our discussion started. The most obvious analogue of Black-Scholes-Merton, the most obvious place to look is the Gaussian Copula model used to value and to rate collateralized debt obligations. Just to give you a sense of that model, I mean, again, I'm assuming it'll be familiar to most people here, but what I've done is to take the simplest Gaussian Copula model, the so-called Vasicek version, to show the distribution, the probability distribution of losses on a large, highly granulated portfolio of assets, each with a default probability of 0.02. You know, so we're talking in the sort of triple B, low investment grade range here. And identical pairwise asset value correlations. So the only thing that's going to tweak in the slides I'm going to show you is those correlations. And I put them up at the top of the slide. So up here, this is 0.01, which is therefore pretty close to the domain of the law of large numbers. So each of your assets has got a default probability of 0.02. So basically, you're going to lose that proportion of your portfolio with not much spread around that. Start increasing the correlation, and it begins to spread out. Top here is 0.01 again. Now we're down to 0.99, when something quite interesting happens. I mean, those of you who know anything about Marxism will remember the terminal crisis of capitalism. Well, this little bit here is, as it were, the mathematical shadow of the terminal crisis of capitalism. At a very high correlation level, maybe nothing defaults, but the graph becomes, the probability density function becomes bimodal, and there's a chance of everything defaulting. So the Gaussian Copula model seeks to capture that crucial role of correlation in determining the shape of the distribution of the probability density function of losses. It certainly is a case of effective performativity. That, in essence, though there's some little twists here that we could get into in discussion if you want, that in essence is how the rating agencies rated CDOs. There is, however, a difference from the Black-Scholes case, because I can't find clear evidence of Barnesian performativity here. There's quite a close analogy between the volatility skew in the Black-Scholes case and what's called the correlation skew in the Gaussian Copula case. And the correlation skew has always been there. So there's no equivalent phase of the skew being flattened out by the equivalent of spreading. And it's interesting organizationally to think why that might be so. It's partly, I suspect, to do with the fact that these contracts are 5-10-year contracts typically, and there's one thing to do an arbitrage over a small number of weeks or months, another thing to try and do it over 5-10 years, particularly to lose money at for the first year, the second year, and you have to say, okay, come on, boss, I know this is going to turn out good eventually, boss. It's difficult organizationally. But I think clear evidence of counter-performativity, particularly the counter-performativity of the use of the Gaussian copula by the rating agencies to rate the particular killer asset class of the credit crisis, ABS CDOs. CDOs where the underlying assets are not corporate bonds or loans made to corporations, but asset-backed securities, particularly mortgage-backed securities. That, assuming modest correlations and low default probabilities for the underlying assets, sets in train processes that dramatically undermine those assumptions. ABSs, I think, is now well established in the literature. Something like 4 or 5 papers have shown this change the mortgage market, and ABS CDOs change the ABS market, both in ways that undermine the empirical validity of the model. What I've done here in this table is to take Standard & Poor's CDO evaluator, which, as the name implies, is the system that Standard & Poor's use to rate CDOs, and to take its default probability, its 3-year default probability assumptions as of June 2006, and those assumptions are expressed in percentages. These are not, this is 0.008%. This is what actually happened in terms of the realized default rate of ABSs. And as you can see, those figures are of the order of 100 times bigger than the assumptions of the model. Now, there are various ways you can think about that. One possibility is the rating agencies deliberately being lax. And I suspect there is a little bit of that, but not, I think, enough to explain that 100-fold difference. Is it model error? Well, of course, in a sense, plainly it is model error, but my suggestion is that it's a very particular type of model error, that it's counter-performativity. That a model with those modest default probabilities and modest correlations, the relevant correlation figure for mortgages that Standard & Poor's was using was 0.3, so not a very high correlation level. So people were in essence able to arbitrage the model. They knew what the model was. I mean, the people criticized the rating agencies for not being transparent, but from the point of view of market participants, they were perfectly transparent. They would simply give you a copy of the model, so you could play around with setting up your CDO. So my argument is there's a sense in which that caused that, brought about a pattern that was inconsistent with the model, which is counter-performativity. The model being used, but the effect of its use being to make market processes less like how they were postulated as being by the model. Thank you.
My question is, what do you see as the implications of performativity or counter-performativity in the use of quotes on liquid options to price illiquid options?
Okay. Well, it certainly is a very real phenomenon. I mean, I was very struck when I visited the Chicago Board Options Exchange by a system called AutoQuote that they use. Now, it's some years since I've been there, but I assume the same system is still in use, and it does precisely that. It takes the price of liquid options and it applies the Cox-Ross-Rubinstein model, which is a relatively similar to Black-Scholes, to price the illiquid ones. So it's actually built into the infrastructure of the Chicago Board Options Exchange that illiquid options are being priced off liquid ones. So there's a certain sense in which that is an instance of performativity in my terminology.
Step to the microphone.
What changes, if any, would you think the default probabilities would have if a longer period were used as opposed to 3 years? 3 years strikes me as a very short period of time.
Yeah.
It may not have captured some serious credit events that occurred further back in history.
Yeah. No, I mean, and indeed, the CDO evaluator went out, if I recall correctly, to 7 years for ABS. So I plucked the 3-year probabilities, the 3-year assumptions, purely for comparison. I mean, essentially, we don't have that long history yet for ABSs issued in the critical years, 2005, 2007. So it wouldn't be fair to Standard & Poor's to say they were only looking at 3-year default probabilities. They were looking further out than that, and I've just chosen them for comparison purposes.
Hi, I'm afraid I have to ask a very naive question. Can you say a little...
If you don't mind a naive answer, that's fine.
I'd be delighted. Okay. I'm just curious about the role of arbitrage in producing that counter-performativity. Okay. I mean, apparently that's the critical lever in the process, if I understood you correctly. Is that accurate?
It certainly is in the case of Black-Scholes. I mean, the effect of people doing the arbitrage that in a certain sense Fisher-Black taught them how to do does flatten the skew. The role of arbitrage here is actually subtly different from that, however. What people were doing in constructing ABS CDOs wasn't like it wasn't like the spreading Fisher-Black case. What people were in effect doing was gaming the rating agency model, whether consciously or unconsciously. That's it is a form of arbitrage, but it was arbitrage of the use of the model by the rating agencies.
Hi, given a model, do you have a suggestion for how to anticipate this phenomenon? And in particular, is it just a matter of bad assumptions or bad coefficients, bad fitting?
Yeah. No, it certainly isn't a matter of simply of bad assumptions, because what in essence I'm positing is that there are cases, and this is a very important part, I would say, of the credit crisis, where the assumptions start out perfectly fine. They start out empirically perfectly justifiable. I mean, that those default probability assumptions were consistent with the default history of ABSs. So it's not a matter of, as it were, picking assumptions that are bad to begin with. It's a matter of the assumptions turning bad because of the use of the model in practice, particularly here in its use by the rating agencies.
I want to try and, in effect, unpack a little bit the performativity analysis the way you've done for the models. The models turn on arbitrage, dependent arbitrage, and I take your point to be that arbitrage isn't a model. It works through real institutions with real frictions, with internal incentives that are skewed. Arbitrageurs aren't price police. They're just trying to make money. And if this makes money, that's just fine. So if you take, can you roll, in effect, roll the performativity analysis down a layer to offer intuitions more generally about the character of those institutions that will cause this reputation? Because if there's a payoff to it in the end, it's a payoff because it helps us think about dealing with those flaws in those underlying institutions.
That's a complex set of issues that the organizational implementation of arbitrage. I mean, I'll set aside some of the bigger questions about institutions and incentive structures and reward structures and so on, because I'm sure we're going to come back to those later in the day. The organizational implementation of arbitrage is an interesting thing, because many arbitrage trades are what people in the business call negative carry. That's to say that they involve you in losing money for quite some time until you eventually get the money. And that can be a very hard thing to sustain organization. I mean, arbitrageur, I haven't yet met an arbitrageur working for an investment bank who hasn't kind of told me about being instructed to withdraw from a position that he or she was confident would turn good in the end. So I think those sort of organizational features, is it a negative carry? If so, how long is it? How long is it going to take? What kind of attitude is your management going to take to it? I mean, those things strongly affect the extent to which, in practice, arbitrage can, for example, close price discrepancies.
So we'll take two last questions. So Michael and Howard will go for it.
This is perhaps an attempt to reformulate the same question. I was wondering if you have any thoughts about how to identify the social situations where you would expect the use of a model to be counter-performative, because it seems to me that the value of the theory is not just to say that in general terms it's always an abstract possibility that using a model will undermine the validity of its own predictions. I mean, at least if that's all one has to say, it doesn't tell one then whether to use models or not. It seems what one would like is to be able to say something about particular kinds of uses or particular situations in which the use is likely to cause the problem.
Well, I think I would say two relatively obvious things. I mean, the first is, of course, scale. Portfolio insurance, for example, would have been a perfectly sensible strategy if only a small number of people had been doing it. It was the fact that a very large number of people were doing it that was the condition, the possibility of the counter-performative effect. And then the other feature is, I suppose, again, pretty obvious, is the elimination of diversity. Because, of course, markets work best when there are different kinds of participants trying to do different kinds of things. The dangerous situations are where too many people are trying to do the same thing. And that's, of course, something like portfolio insurance. If everybody is trying to sell, that's plainly dangerous.
I have a very short question. I just wanted to ask if you saw any implications for counter-performativity for regulatory policy.
Again, I suspect my answer is going to be a pretty obvious kind of answer, which is that if you build models into regulatory structures, into regulations and the like, expect people to game those models, and expect one of the possibilities to be the creation of phenomena that are at odds with the postulates of the model.
We're going to have a chance to discuss these things in the panel. Take some of the burden off. Donald trying to answer all these complicated challenging questions. But this is for the purpose of intellectual exercise with no response. Maybe Gerd and David can just pose their questions, and we'll pick it up during the course of the day.
You quoted Steve Ross having said in 87 that the option pricing formula is really the best, most effective formula in economics, in all economics. The implication was that he didn't think so. Can you mention another formula in economics? My inference from what he said was that you may disagree with what Ross said. So my question is, can you suggest a more effective formula in economics that works more precisely than the Black-Scholes formula?
I could answer that in like 20 seconds. I think it was a perfectly valid thing to say in 1987.
Well, today, are you aware of a more effective, he compared this with economics, not with physics, not with Newton's laws, but with economics. So the question is, can you identify a result in economics that is more precise?
What is your answer?
I didn't make that assertion. I didn't quote Steve Ross having said that. I put the fifth.
David, what's your...
So in the first part of your talk, Tom, when you're standing on the stage and telling us what performativity and counter-performativity, or if I understand, performativity is when the use of a model increases its predictive fit. Counter-performativity is when the use of a model decreases its predictive fit. But as Mark's question also we understand, in this last example, is it the use of the model that increased its predictive fit, or was some actor's knowledge about the use of the model?
In a different modality, decreased its predictive fit. Now, I don't want to be nitpicky about counter-performativity, but the question it raises is, how does the use of models or the development of models change when actors begin to take into account that other actors are using models?
Yeah, I think that is a classic panel question, isn't it? I don't think I should attempt to answer it.
Thank you so much, Donald. One quick observation. That's a terrible chart for social science, but as Paul and I were noting, the rank order correlation is pretty good. So at least the ordinality is. Let's click on the next panel. Okay? Thank you very much.